Welcome to this course on investment analysis and portfolio management. In this program, we will examine the essential theories, strategies, and practices that guide investors in making informed decisions and constructing efficient portfolios. Investment management is not only about picking assets but also about understanding markets, risks, returns, and the psychological behaviors that shape financial choices. This first module focuses on building the foundational knowledge, financial and capital markets, investment instruments, derivatives, hedging and speculation, and the tools of security analysis and valuation. Section 1. Characteristics of financial and capital markets. Financial markets are platforms where funds are exchanged between investors, corporations, and governments. They play a vital role in allocating resources efficiently, providing liquidity, and facilitating price discovery. We can broadly classify these markets into money markets, for short-term borrowing and lending, typically under 1 year. Examples include treasury bills and commercial paper. Capital markets, for long-term financing, involving equities, bonds, and other securities. Key characteristics of efficient markets include transparency, liquidity, low transaction costs, and effective regulation. In well-functioning markets, prices reflect available information, enabling investors to make rational choices. Section 2. Risk investment instruments. Investors have a wide range of instruments to choose from, each with its risk-return profile. Equities, ownership stakes in firms, with potential for dividends and capital appreciation. They are high risk but also high return. Bonds, debt securities that provide fixed interest payments. They carry lower risk but may be exposed to interest rate or credit risk. Mutual funds and ETFs, pools of securities that provide diversification benefits. Alternative investments, such as real estate, commodities, and private equity, offering unique risk-return characteristics. The choice of instruments depends on investor objectives, time horizon, and risk tolerance. Section 3. Derivatives, options, and futures. Derivatives are financial instruments whose value is derived from underlying assets like stocks, bonds, or commodities. Options provide the right, but not the obligation, to buy or sell an asset at a set price within a given time. They are useful for hedging risks or speculating on price movements. Futures are standardized contracts obligating the buyer to purchase, or the seller to deliver, an asset at a future date and price. Derivatives can amplify gains but also magnify losses, making them powerful yet risky tools. Section 4. Hedging and speculation. Two major uses of derivatives are hedging and speculation. Hedging is like taking insurance against adverse price movements. For instance, an airline might hedge against fuel price increases by using futures contracts. Speculation, on the other hand, involves taking positions to profit from expected price movements. While it can yield high returns, it also carries high risks. The balance between hedging and speculation is critical in understanding the behavior of modern financial markets. Section 5. Security analysis and valuation. Security analysis helps investors determine the intrinsic value of assets. There are two main approaches. Fundamental analysis, examining financial statements, industry conditions, and economic factors to estimate fair value. Technical analysis, studying past price patterns and trading volumes to predict future movements. Valuation methods range from discounting expected cash flows to using market multiples such as price-to-earnings ratios. The goal is to identify undervalued securities to buy and overvalued securities to sell. In this module, we introduce the foundations of investment analysis by exploring the structure and characteristics of financial and capital markets, investment instruments, derivatives, and their applications in hedging and speculation. We also touched on the basics of security analysis and valuation. Next, we will advance into more sophisticated concepts such as risk-return analysis, portfolio theory, behavioral finance, and the challenges of investing in an interconnected world.